So when we're talking about a collateral loan versus a policy loan, this is really quite simple, actually, because really what you're doing, you take this exact same policy. Let's say you've got a $250,000 policy, and your cash value is $50,000, and you want to borrow $50,000, let's say, okay? So therefore, rather than take a policy loan, which, as you saw before, creates some tax issues and everything else, you say, is there an alternative? The answer is yes. You can take the exact same policy, go to a bank or financial institution, trust or lending institution, whatever, okay? Based on our example, we'll take the policy to the bank, and you basically collateralize the policy to the extent of the cash value. In other words, I've got $50,000 sitting in here. If I borrow from the insurance company, they're going to tax me. I'd like to borrow from you. So basically, it's a secure loan. So the bank then will grant you that particular loan. So the cash value itself will act as collateral for that loan. So basically it's a secure loan, secure creditor. The nice thing about doing a collateral loan, of course, is the loan is in fact tax-free. Okay, it's tax-free. So therefore, the fundamental difference between a policy loan and a collateral loan is a policy loan may trigger taxation in a collateral loan because you're not actually affecting the policy at all. Okay, you basically collateralize the policy and that's it. So the loan is not coming from your policy. It's not coming from the insurance company. It's coming from basically an arm's length institution such as a bank, for example. They give you that loan. That loan will be in fact tax-free. So same amount of money, $50,000 a little bit, but it doesn't have any impact on your ACB. Doesn't have any impact on any of the taxation issues that we talked about before. Okay, and again, if you ended up borrowing that money for business purposes, in other words, you took that money to invest in your business, or you wanted to buy stocks or bonds, or in other words, to create investment income, the interest that you're actually paying on that particular loan will also be tax deductible. And that applies whether it's a loan from the insurance company or whether it's a loan from the bank. Okay, the moment you use that money, you're not using it for personal use, but you're using it to invest in your business or invest in stocks and bonds, or in other words, generating income and everything else. Interest is always deductible. So one of the things that business associates, for example, business company do, that they have policies that say on key people or the owner, whatever, they build a substantial amount of cash, and then they go to the bank and they've actually bought money using that policy and everything else, and that could, the interest on that could be deductible if you're using that money, obviously, to increase your business and everything else. Okay, so that is in a nutshell what the issue is in terms of a policy loan versus collateral loan. Okay. Now, there is a possibility, of course, that sometimes when you get dividends, okay, that, in other words, in a participating policy, there could be a situation where dividends could also be considered taxable. Now, as you know, dividends are not capital dividends in this case here. They're basically a return of your own money. So theoretically, the dividend is basically a return of your money. So therefore, theoretically, it should be tax-free. Everything else. Not quite. Okay, not quite. If you're taking the dividend, remember there's 5 dividend options. Okay, if you're using the dividends to buy paid up insurance, for example, and it increase your coverage, or you're buying term insurance, things of that nature there, then there's no taxation in that. So you don't have to worry about that at all. The only time the dividends really are going to be taxed would be in 2 situations. If you leave the money on deposit, and therefore it gains interest and everything else. The secondary income, okay, the income that you're earning on that secondary income, whether you invested in interest-bearing notes or segregated funds or whatever it is that you invested in, that secondary income, of course, that will be considered income. So what they call Part 2 income, basically. So if you leave your premiums on your dividends based on deposit, and the deposit gains secondary income, you will have to do a bit of reporting. The initial dividend itself, that will simply be a return of your own money. If, on the other hand, you decided to take that dividend in terms of cash, then in other words, cashed out, then once again you've got an ACB situation. So the difference between the ACB, basically, in other words, the same old situation, the difference between the adjusted cost base, which once again is calculated the same way we did before, okay, and the actual dividend itself that you received, that difference will be taxable. Okay, so you have to keep that in mind, is that if there is an actual dividend that is paid out, and that dividend, remember, it's paid out, so you're taking the money in cash, basically, okay? So if you actually take that money out in cash, then the difference between the adjusted cost base of the policy, okay, and the actual dividend itself that you receive, okay, that difference will be considered taxable income, so it has to be reported. But if you leave the money sit on deposit, only the gain itself will be any gain that, of course, will be as Part 2 income or secondary income. So therefore, that will be taxed. But if you take the dividends and you use it for insurance purposes, like I said, if you use to buy paid up insurance, for example, or to buy term insurance, things like that, or APL, an automatic premium loan. In other words, that you're using the premium, in actual fact, using the dividends to actually pay the premiums and everything else. Again, those are insurance options. So if you use your dividends to say reduce my premium, because I want to reduce the premium on my policy, those will all be tax-free because you're actually buying insurance. Okay, so that's not an issue. So the only real time you have any real issue when it comes to dividends is if you actually take them out in cash. In that case, then the difference between the ACB and dividends, that will be taxable. And the second option is if you leave them on deposit and the secondary income, basic second generation income, that will also be taxable. Other than that, if you use the dividends for insurance purposes, then there will be no taxation on those dividends whatsoever. So they'll be tax free. So there'll be no reporting on these as well. Okay. So remember, this only applies, of course, on participating whole life insurance. So non-par, this has nothing to do with it. Universal life, of course, is non-participating as well. So that has nothing to do with this either. It's only really limited to participating insurance. Okay.